Hi everyone, Simon Barwick here from Bentleys Wealth Victoria. Hope you're well. Just presenting our monthly portfolio market update. Firstly, this information is general in nature, so if you do have any specific questions, please speak to your advisor. Well, market volatility returned in July, and this was on the basis of renewed Middle East tensions and sharp movements in the oil price, and also inflationary concerns. Technology and semiconductor stocks experienced a significant correction, while Australian equities outperformed global markets. But despite these challenges, global economic growth remained resilient and corporate earnings remained supportive. So our outlook for equities going forward remains constructive. If we look at some key messages going forward, the global economic growth remains resilient despite these softer economic conditions. AI continues to drive earnings really through productivity gains, investment spending, and etc. Current US equity valuations continue to be supported by earnings rather than speculation. Australian investment grade credit continues to offer more attractive value than global credit markets. Australian inflation pressures continue to ease, where in the US they remain a bit more persistent. And from an interest rate perspective, we believe that they'll remain higher for longer, although the RBA may be approaching the end of its tightening cycle. If we look at the July markets in more detail, the Australian Australian All Ordinaries gained 1.7% in July, and this was really driven by energy stocks increasing by around 12.2%. Financials gained 5.8%. Technology stocks fell 2.8%. And softer inflation data increased confidence that the RBA may be, as I said before, nearing the end of its tightening cycle. In the US, the S&P was broadly flat, fell by 0.1%, which was vastly different when you compare it to the NASDAQ, which fell around 11%. So that was almost entering correction territory. In Japan, the Japanese equities also declined by 8.1%. In Europe, the FTSE gained 3.6, the German DAX gained 2.5, and emerging markets declined by about 3%. If we look at commodities, the crude oil rose by 22% on the back of that tension in the Middle East. Gold gained around 0.3%, so largely flat, and iron ore declined by 3.6%. When we look forward at our global economic scenarios, as mentioned in previous presentations, we divide these really into three sections. First one is our risk off, and that's really characterized by a deep recession. We think there's probably about a 15% chance. If we look at scenario 2, which is below trend growth, we think this has got a 55% chance going forward, and this is really characterized by, as in the name, lower than expected growth. The US economy remains the driver of global returns, and AI will continue to support earnings, and the inflation will remain stubborn. If we look at the third option, which is growth stabilization acceleration, we think there's a 30% chance of this happening going forward. And this is where earnings growth happens in all regions. And AI also continues to drive stronger economic outcomes. If we look at our macroeconomic conditions, as we've mentioned, these have been softening following recent energy price shocks. The US remains the strongest major economy still. Investment sentiment retains strongest in the US, and inflation remains elevated. Our view is that the global growth will remain resilient going forward. Equities will provide better opportunities than bonds, and higher for longer interest rates remain a challenge for long duration bond investors. So from an asset class, government bonds, we're sort of maintaining our exposure really for diversification. We prefer Australian government bonds over global bonds. If we look at investment grade credit, we prefer high yield, and Australia credit offers attractive income and relative value. If we look at global equities, we still prefer them over Australian equities going forward, and this is really supported by stronger earnings growth. Small to mid caps, we're going to maintain our exposure despite increased volatility in the short term, but the earnings outlook remains supportive. Gold continues to provide diversification benefits, and that's supported by the geopolitical uncertainty and central bank demand. Private equity venture capital is positive still over the long term. Emerging markets, they have positive outlook and really by longer term growth and continued beneficiary of AI investment. So we've covered stagflation previously, which is my final point today, which is really where inflation remains high while economic growth, slows. This is where also consumers are finding or facing rising costs while businesses have weaker demand. And this can often result in lower living standards and weaker confidence. Now, this really last occurred in the 1970s, and this was characterized by rising energy prices, which drove inflation sharply higher while economic growth weakened. So fairly similar to what we're seeing today. So this is different from previous recessions because we saw slowing growth and falling inflation out of the 4 of the last 5 recessions. Central banks are generally able to cut interest rates to support growth, but stagflation really doesn't allow this because we've got weak growth and higher inflation, and cutting interest rates by central banks will just worsen the inflationary problem. So it is really, really challenging. So policymakers need to balance inflation control with supporting, employment and economic activity. So, in closing today, our base case remains that we expect below trend but resilient global growth going forward. Corporate earnings continue to provide support for equity markets. We continue to prefer global equities over Australian equities. Australian credit remains attractive. Portfolio diversification remains critical, given ongoing inflation concerns, interest rate and geopolitical risks. And while short-term volatility is likely to continue, maintaining a long-term investment focus is the most effective strategy going forward for investors. Well, that's me again for this month. If you do have any questions, please speak to your advisor, and we look forward to seeing you again soon. Thank you.